Hello, good afternoon, everyone. Welcome to the Grow and Inspire conversation for today. And we're going to discuss some complexities on taxes that business owners need to focus and manage accordingly so that they can grow the business more effectively. In this episode, we're going to be deep diving into the world of tax concerns that every entrepreneur should know about, from common pitfalls to expert strategies for staying compliant and saving money. Whether you're just starting out or already running successful business, understanding the ins and outs of tax laws can make a break on your bottom line. Let's explore how you can navigate the tax maze and set up your business up for long-term success. So let's stay tuned and continue. With us is today Donna Yam. She's an expert in strategies, financial planning, and taxation, and she has some information that we want to share with her. Can you please comment on your backgrounds?
Thank you very much, Adio. I'm very honored to be with you today, and I'm very interested in helping and really love to share my knowledge in financial wellness. I own a pension consulting business, and I also assisted with Medicare planning, business exit planning, and now taxes too. So I've given lots of seminars, including education through SUNY, WCC, and I'm very happy to be sharing today with you my knowledge in today's podcast, Business Taxes for Business Owners.
Great, great. Thank you very much for being here with us. Uh, Talking about the corporate structure. What would you recommend to a business owner on this topic?
This is a very good question. So, okay, so there are multiple different type of corporate structure that you can decide on. So let's start with a simple one. Sole proprietorship. So if you are a solo entrepreneur, so maybe you just want to keep it simple, you're starting off, you're okay to be responsible for everything, then I also suggest start simple, start small, and don't have to pay a lot of expenses. So you file a Schedule C. There's a minimal amount of paperwork. You don't have to incorporate. All the profits goes to you, and you have full control. Now, when you file a Schedule C, okay, their expenses, their income after you finish, the net income, you have to pay payroll taxes, 100% payroll taxes. So that's some additional money that you have to be concerned about, because other corporate structure you might not have to pay 100% on the income and earnings. Okay, so another one a little bit more complicated than the sole prop, partnership. If you have more than one person, so it's a partnership. Same thing like sole prop. Okay, you would have to be responsible for 100% of the payroll taxes on the net income. Now then, we have a very popular corporate structure design called LLC, Limited Liability Company. Now, let me back up for a little bit. Sole prop and partnership, you are responsible for 100% of the business debt. And then if the business cannot pay for it, it goes to your personal side. So if you want that to draw that line, have an extra protection, what you really want is to set up a corporation. So limited liability corp, a company, will offer you that liability protection. So if anything happens, it's only the company. The company goes bankrupt, it will not affect you personally. So that's a big deal. Okay, so for small and medium-sized businesses, and you need that liability protection, you have the ability. You can have the option to set up a LLC. Now, LLC is a little bit complicated because it gives you a lot of flexibility, a lot of options. So if you are only one person, you can default into a sole prop. Now, remember sole prop? I said you have to pay 100% of the payroll tax on all the net income. All right. So that's what happened. But sole prop, if you don't file, you're not incorporated, you don't have liability protection. LLC, yes, you do. So, oh, okay, I pay a little bit more, but you have liability protection. So I like that. Okay. And then also, if you want to make it tax wise, more beneficial, you can consider to elect to be an S corp. So what is an S corp? Okay, so it's a corporation, so you get liability protection. And instead of all the income flow through and you have to pay payroll taxes, you pay yourself a W-2. So whatever I I should make from the work that I give to this company, you put it as a W-2. W-2, all income there is subject to payroll tax. Now, after you pay the W-2, all the income from the S corp will not get taxed. It get flow through to your personal income tax. No payroll though. So no double taxation, and then only pay payroll tax on the W-2. So unless you claim a very, very high W-2, so you really help, you're minimizing on the payroll taxes and double taxation. Okay, so we'll talk about C Corp, which is a little bit more advanced, more complicated because it gives different layers of share classes. A lot of times people pick C Corp not just for liability to protection, but to raise money, raise investment, and eventually go public. So once you elected as a C Corp, the biggest concern is double taxation. Anything, all the income from the C Corp, you pay income taxes. Okay, income taxes on the corporate level. Then after you pay the net income, after you pay off the corporate taxes, goes to the owners, right? And then when they get passed through to the owners, what happened? You pay your personal tax two times. S corp, corporate tax, everything get passed through to the individual level, except the W-2 that get issued to the corporate owners. So you save a lot of money from payroll taxes from the S corp. C corp, you get more benefit because there's even more protection and easier for you to raise money, especially if you want to raise money internationally. They want to make sure that you're C corp. So those are the corporate structures. It can get a little bit complicated, but I would say, depending on what you do, if you want liability protection, definitely a corporation would be advisable.
So the most viable entity for a small business is actually the S corp.
S corp or
And,
LLC.
and if they want to start with an LLC, they can take the election of an S corp for tax purposes only
Exactly.
and reduce the taxes.
Exactly.
Oh,
Exactly.
okay,
Thank you. Yep.
that's a good strategy. Yes,
It's
yes,
complicated, but it's worth doing it.
it is. Okay, so why, besides that important aspect that we just saw on the tax liability, why is it so important to determine how the business will be taxed?
Are you
Why?
talking about estimated taxes?
Yes.
Okay, so estimated taxes, okay, so you're liable. Okay, so we normally report tax at year end, okay? So for company is May 15th, for individual is April 15th, but we're talking about company. So let's say it's March 15th, okay? But a whole year, I mean, you're making lots of money, but the government is not benefiting from any of your income. So they said, no, I don't want just to get paid once a year at the time that you file taxes. I want you to file estimated taxes. Okay. So what is estimated taxes? It's basically every quarter you estimate what you owe to the government and then you make estimated payment to the government. That's paid before you file taxes. And when you file your taxes, whatever you paid on the estimated taxes will be used to deduct what you actually owe to the government. So that's what it is. So the requirement is that if you think you owe more than $1,000, which is not much at all, right? So most likely, so you would be reporting estimated taxes. And if you use payroll software, no, I mean like QuickBooks, any of these accounting software, they would have like a tab. They will help you keep track of the date that you have to send estimated taxes. And you just click that little link and then answer some questions. Click. They help you track the amount that you have to pay, and then you remit the money. So that's normally how it's done. And the form that you use is called 1040 ES.
And what happens if I either skip or forget to make any
Penalty.
of those payments?
Penalty.
Penalties. So in
Oh,
other words, it
yeah.
costs us it costs us more money.
Because you're supposed to make
Right.
the payments on a quarterly basis. Yeah, let me be more specific. It's April 15th, June 15th, September 15th, and January 15th.
Okay. And to reduce or maximize the revenue of the business, what kind of expenses can you deduct?
All right, so when you run a business, there are always going to be some expenses. So what they call is ordinary and necessary. So if you spend money that's not necessary, you're not supposed to, okay? So be careful about that. So let's say, okay, give some examples. Rent, office rent, of course. Utilities, internet. Everybody needs internet nowadays,
Right.
okay? And office supplies, equipment, marketing and advertising to help you bring in more clients. And those are all deductible. And if you hire employee wages, and then travel expenses, and of course, travel expense not for personal travel expense for business. And of course,
Business.
there's meal, and then there's a vehicle and all that. That's a little bit more complex, but some portions of that, 100%, 50% of the meals will be, 100% of the travel expenses and 50% of the meals normally can be deducted.
Right. Okay.
Just make sure you keep good records.
Exactly. I was going to ask about that because it is important to keep a copy of the receipts because if there is an audit, they will ask for receipts.
I mean, this is business. You should. Okay. Personal expense, I don't care, right? You can throw it away, the receipt,
Yeah.
okay. But if it's business, you have the responsibility to keep track.
And if I work from home, which is today's type of
Right.
employment, either combined or 100% from home, what can I deduct on my home office expense?
All right, same thing. You need to keep track of what is being spent. So, your home, I mean, I can't say that you use 100% of your home just for business, otherwise you call it like a business property, right? So you have to figure out like, okay, what area? So you should have a designated office area, okay, with your computer, your desk, where you put your filing. Okay, that's my office, home office. And then you keep track of the square footage and then how much expense, the percentage of the total expense, and that would be attributed to your home office deduction. Or you don't want to do the complicated way. The simplified method is $5 per square foot up to 300 square feet, which is not a lot.
That's the easy way out, okay?
Mm.
Sounds simpler than having to measure every corner of the area. And what about the assets
Oh, company
that
assets. So
that
yeah.
I have? Yeah,
Oh yeah, like equipment, computer, office
right.
furniture, and all that, right? Okay.
Yeah,
So we all have some type of equipment. So we start off with, okay, so with the purchase price, you start up how much did you pay for buying the equipment or the furniture, and then you tag on maintenance or some upkeep, repair, all that stuff, right? And then that will be your book value. All right. And then a lot of times what you can do is depending on the useful life. So let's say 5 years for the computer, 7 years for office furniture. So you divide by 5 every year, you deduct 1/5 of that expense that you've spent on that particular property. But then, we have a few more choices. This is the easy way. So 5 years divide by 5, 7 years divide by 7. That's all like regulated by the IRS. It has certain rules about different furniture. Okay. So, there's also another way, it's called accelerated depreciation. So it's a little bit more complicated, but it's like 150% of what you're supposed to when you divide by 5 or 7. It's a little bit more complicated. It's called accelerated depreciation. Or you can do bonus depreciation, section 179. All that is yes, it requires additional calculation and bookkeeping. But if you think you are making nice income, so you want more deduction, then it's advisable to take more deductions. You still can't take more than 100% of what you spend, but you push more to the earlier years. So if you are not netting a nice profit, then if you try to deduct too much of the early years, then then you're wasting your deduction. So might as well just take the straight line. Okay, so all depends on your income status, and then you decide whether you want to advance like accelerated depreciation or just straight line.
Okay, that's a good tool to use, Section 179. Now you mentioned before payroll taxes.
Yeah.
How do we handle
How does
that?
that work, right? Okay.
Yes.
So if you issue a W-2, you're supposed to do withholding. Okay, so besides the payroll tax withholding, you're also supposed to withhold federal and state income tax for your employee. So when they file, okay, they already prepaid some of the taxes that they owe to the government. So it's not like you have to pay 100% when you file taxes. And besides that, you know that at 65 we start getting Social Security or Medicare. That's something that's given by a service created by the government. Somebody has to pay for it, the services, right? So they start collecting it from how much you make. So for Social Security is 6.2% of your income. Medicare is 1.45, and if your income exceeds 200,000, file single, or 250, married file joint, there's another 0.9%. Okay, so on Medicare taxes. So that's the additional that you have to withhold on for the employees. That's 50% of what you're supposed to pay for the FICA. FICA is Social Security plus Medicare, and the other 50% is paid by the employer. So that's that. And then on top of that, there's something called a FUTA, Federal Unemployment Tax Act tax. So for people, once in a while, you get laid off, you don't have a job, then you get unemployment benefits. Where does that come from? That's the tax that the company is paying on your behalf. So when somebody gets laid off, they're entitled to some money to help you through the financial situation.
So it's a type of insurance, basically.
Yes. Yes, you're right.
Okay. And what if I'm self-employed?
Good question. If you're self-employed, then you're the employee and the owner. So what do you think? Times two.
Okay,
So
so
you
it's
pay
not
you pay the company portion,
so
the 6.2.
if as an employee I'm
Yes,
paying
and the employee. So what if,
50% of
yes,
that,
you
now
got
I'm
it.
paying
You
100%.
got it. Now the good
Okay.
thing about this is like it's tax deductible. The company side, that 50%, you call it business expense, right? So you can deduct that 50%.
Okay, so basically paying the 50% still, only in a
Yes,
different,
50% you
yeah.
have to pay, and
You gotta
50% you still
think
have to
about it
pay,
that way and
but you get
still
to
pay.
deduct.
Yeah, yeah,
Yep.
yes. That makes us feel better.
Mhm.
And what kind of credits are for business?
Business, there are quite a lot. I'm not sure everybody knows about it, so let's go through the list. That's quite a lot. So let's say you have employees with babies, kids, and all that, and you want to provide childcare facility. Of course, we're talking about slightly bigger company, otherwise it's not worth all that work. So this credit for employer provide childcare facilities, up to $150,000 a year. So if you want the employees to be productive and they have young kids and they need assistance with childcare facilities, then you can actually assist them with that service and you get credit for it. That's one. And the other one is like government really wants you to start saving for retirement and start early as possible. So if you are a small company and you want to, or a new company, you want to set up a retirement plan, the Secure Act 2.0 will give you up to $5,000 tax credits per year for 3 years. So take advantage of that. And then there's some other like, auto enroll $500 and then company match $1,000 per employee, but it's scaled down in 5 years. Okay. So there's like a lot of like credits that's given to small employer to help them run the pension plan, 401k plan. So take advantage of that. And also there's tax deduction of anything that you put in your 401k, pre-tax, so you don't have to pay taxes on the amount and the contribution. And there's research and development tax credit. So for companies that want to engage a little bit more in research and development, you might be able to get some tax credit for doing research and development. Disabled assets credit. So we want to help a certain employee group. They need assets. They need certain type of jobs. It's hard to get, and if you provide that type of job, then you might get some credit. Here's another one. Small business healthcare tax credit. Healthcare premium is like, out of the roof, very expensive. So if
Yes,
you have less than 25 full-time employees and the wage of the employees are no more than $56,000. So we don't want super rich employees. They might be able to afford the insurance premium.
right.
So you be able to get up to see everything we need the payroll statistics up to 50% credit on the employee premiums that you pay.
That
Uh,
is big. 50%
yeah,
is big. Yes,
and if it will have count, right? So check it out.
right.
And there's work opportunity tax credit for hiring individuals for certain target groups, employee retention credit for training employees during specific economic disruptions, energy efficient and renewable energy credits. And then new market tax credits, same thing, encourage investment in low income and underserved communities. Now, here I want to say, we talk about 5, 6, 7, all kinds of credits, lots of credits. You need to do some research on it because besides getting, let's say you can't use up all the credits, there could be some carry forward and carry back too. So you might be able to use it for multiple years. So check that out. And also, what we're talking about, besides the federal level, state level, you might be able to deduct state taxes too. So depending on, is it energy credit, energy efficient credit, or something for employee, certain groups of employees to facilitate them in getting employed, or like new market tax credit, state might also be helping out with some credits too. So check that out.
That is great. It's a lot of information there. And talking about health and savings, what can you say about retirement plans?
I think that's the best way. Okay, a lot of people already know about 401k, so I don't have to talk about 401k, but let me just tell you, as an employee, you can contribute up to $23,000 a year. That's quite a lot of money. And then if you're 50 and above, another 7,500, we call it catch-up contribution. So that's what, 30 something thousand dollars. That's a lot of money for people to save every single year. Now, if
Yes,
I am a professional, like actually like a medical professional, a lawyer or architect or whatever, they make some nice money, and then they think $23,000 or $30,000 contribution to retirement account is not enough for me because I start saving late because I am a doctor. I don't start making money until I'm 40 years old or something. So I want to save a lot, while I can, right? So another way to save is besides the 401k plan, you can consider something called a defined benefit plan or cash balance plan. So they kind of work backwards. So they assume that you can save up when you're 65, $2.5 million. So work backwards. So the older you are, the more you can put in. So you can, depending on how much you make, how your longevity, how close are you to retirement, they work it backwards to figure out how much can you put in per year. And then can be so much more than 401k. It can be $265,000 a year, depending on your age. And we just recently looked at somebody who's only 39 and she can put in 165,000. That's quite a lot.
yes,
Yeah.
yes. It is a big saving because
Mm,
that money is not taxable, right?
that's what?
That money is pre-tax. It
Pre-tax.
doesn't pay income tax
Hmm.
until you retire,
Yeah.
which is a big saving. If you know how to manage it, you'll be saving a lot of money.
Well, let me comment on one more thing is because when you make a lot of money, it's not just the taxes absolute. It also because our tax structure is layered. Okay, the more money you make, the higher your tax rate is. So by cutting your income might lower your tax rate maybe from 35 to 25%. So everything is lower. So it's not just the amount of portion of the amount of money that you put in the retirement plan. The rest of the money could be taxed at a lower rate because you basically lower your taxable income.
So that's That's the game plan,
That's a
actually.
game
Just
plan.
reduce
Yes.
the income so that we reduce the tax bracket.
Yes, when I make money, a lot of money, I don't want to report so much money. I want to lower it. And one way is to actually, it is a very legitimate way because they want you to save for retirement
Yeah,
to put
right.
that into a retirement account.
Now there is another issue that a lot of people complains about it, and a lot of business owners also complain because they don't understand exactly how it works. Is the sales tax?
Good question.
Can
Yeah, it
you
is so
elaborate on that?
complicated. Yes.
Yeah, yes,
Yeah, if you sell products, okay, it's taxable. Like service, no, but products, yes, okay. And then I don't care if you sell it online, now it's still taxable. And it's so complicated because it depends on whether you have physical location or a nexus or like the sales volume. It varies depending on state. So some states will say, yes, we have to collect sales tax. Some say maybe if the volume is under whatever, okay, we don't collect whatever. So it gets pretty complicated. So when it comes to sales tax, I would suggest talking to an expert, a tax advisor, and get them to assist and help you figure out how much you have to remit to the government.
right, right. So, yeah, it's too complicated. And what about state and local taxes?
Well, they also have to get the fair share. Well, nothing is free. But I want to say it's complicated because every single state have their own way of taxing and also giving out credits. It's very interesting that I don't know if people know that on a federal level, Social Security is being taxed if you make a certain up to a certain income, then the additional would be taxed. But in New York State, what do you think? Social Security income is not taxable. So you would have to be reporting the tax differently. Okay. So yes, it's also, again, it's complicated. It's another layer of tax that you have to pay, but also depends on the rules and regulations. Some yes, some no, and the amount also differs.
Right. Okay. That's very important. Um, we're at the time where we have to end the session. We got a lot of information, and today's episode, I think it brought a lot of information and will make this mostly the small businesses, the business owners understand what they need to do, what kind of deductions, what credits they have to look at and make sure that they are taking advantage of that,
Mm. Mhm.
right? If someone is unsure of what to do, that they just call us, call an expert, and
Yeah. Mhm.
ask for further explanation of what needs to be
Definitely.
done.
Yeah.
Well, hope everyone use the information the best we can, and we thank you. We'll hope to see you again on another episode of.
Yeah, let me give you a quick summary though, okay, because we talked about so much. I want to repeat what Tio says. Number one, make sure you have good accounting records. That's number one. Before you can even do your taxes, you have to have good record keeping. Okay, that's number one. Number two, I want to point out is timing is important because you want to know how much to deduct. You want to accelerate your expenses or you want to decelerate. So depending on how much money you make. So you want to report more expenses, less expenses. Some of it can be your decision. So it can be big like the depreciation. You want to do like straight line or you want to do accelerated. Some of the timing you can control. So think about that. And then entity restructuring. So if you are sole prop and you're paying all that payroll taxes, and let's say I'm making a $300,000, I think there's a better option for you. So please think about maybe you want to incorporate. That's also help you with corporate liability protection. So I would advise you seek out some help on that. And then just one last mention. We don't have time to cover that, but charitable contributions. Okay, you can also assist people and also do well on taxes too. But that's another topic.
Great, thank you very much, and until next time.
Thank you. Thank you. All right, wonderful.
Bye.
Thank you.